Hi, welcome to Novid.com. In this lesson, we shall look at Introduction to Balance Sheet, at the end of which, you will have a fair idea of what comprises of a balance sheet, and how to prepare a basic sole proprietor balance sheet. Every firm has three primary financial statements, which are balance sheet, income statement and cash flow statement. Balance sheet is a snapshot of the business assets that the business owns and what the business owes, as on the date of the balance sheet preparation. It is one of the most important financial statement of a company. The balance sheet will tell you what are the financial obligations of the company, how much money is invested, is the company overly indebted, and what assets has the company purchased with its financing. The balance sheet is based on the accounting equation, assets equals liabilities plus equity. That is, for the firm to procure assets, it needs to obtain cash, either by borrowing as debt, or from the owners as equity. The accounting equation can be rearranged to know the net worth of a firm, that is, what is left for the owners after all assets are sold and liabilities are repaid. Therefore the equation becomes assets minus liabilities equals net worth. For example, if a firm has 100 crore as assets and 70 crore in liabilities, in the event of liquidation of the firm, the shareholders will be left with 100 minus 70, which equals 30 crores, which is the net worth of the firm. Let us look into a few definitions associated with a balance sheet. Firstly, what are assets? Assets are any property owned by the firm, which are either tangible or intangible. Tangible assets are those which are physical, such as buildings, machinery, land, while intangible assets are those which are non-physical, such as goodwill, copyrights, etc. Assets can be classified into three types: fixed, current, and fictitious. Fixed assets are also known as capital assets. These are assets where substantial amount of money is invested. These are the assets which the business owns, with the intention of generating profits. Current assets are cash or can be converted in the form of cash within a short period of time, that is under 1 year. These are the assets which the business uses to pay off debt and other liabilities. Fictitious are not real assets and they cannot be sold. These are created to write off, that is to be reduced from profit. For example, preliminary expenses are usually written off. Preliminary expenses are those expenses incurred by a company before its existence. Expenses such as legal fees, company registration expenses, etc. are fictitious expenses. Similarly, what are liabilities? Liabilities are obligations which the business has to repay, such as loans, debts, etc. Liabilities are classified into long-term liabilities, where a payment time frame is between 2 to 15 years, and short-term liabilities, where a payment is under a year. Shareholders' equity is the value of a business to its owners after all its obligations are met, which is the net worth of the business. The net worth can be subdivided into equity capital, retained reserves, and profit and loss. Now, since we are at it, we shall briefly look into certain other terms, such as book value and book-to-market ratio, through an example, before looking into a balance sheet. Let us consider a company XYZ, which has 100 rupees as assets, 80 rupees as liabilities. Therefore, the net worth of the company is assets minus liabilities, that is 100 minus 80, which is 20. Now, if XYZ has 20 shareholders and if they decide to wind up the company, then each shareholder will get 1 rupee each, that is 20 rupee divided by 20 shareholders. This is called the book value. Usually, this book value is compared with the market value, that is the market price of the stock in the stock market. If the market price for XYZ is 2 rupees, then the book-to-market ratio is 1/2. This means, although the actual value of the company today is 1 rupee, the investor has anticipated a better future and are betting on the company. Let us compare this with another company, ABC, which has the net worth of 20 rupees and book value of 1 rupee. but a market value of 0.5 rupee. Here, the book-to-market ratio is 1 divided by 0.5, which is 2. So, XYZ has low book-to-market ratio, and ABC has high book-to-market ratio. Anything more than 1 is high book-to-market ratio, and less than 1 is low book-to-market ratio. So in XYZ, market is betting more than the book value, anticipating a better future, whereas in ABC, it is traded less, so investors are not speculating. A sole trader uses the T format of balance sheet, while companies use the statement format of the balance sheet. Let us look into 10 items and place them appropriately in the balance sheet. The items are: capital, 10 lakhs, drawings, 50,000, net profit, 1,50,000, buildings, 5 lakhs, furniture, 7 lakhs, creditors, 2 lakhs, bills payable, 3 lakhs, cash at bank, 4 lakhs, debtors, 1 lakh, mortgage loan, 1 lakh. In the sole trader's balance sheet, there are liabilities on the left-hand side and assets on the right-hand side. Balance sheet basically specifies, as on a particular date, what is the position of the business. Therefore, we first put the heading, balance sheet of XYZ, as on 19 December 2019. Now, for our exercise, we need to transfer each of the 10 items to the balance sheet, and we need to identify which item should be placed under liabilities and which under assets. Liability indicates the responsibility of the business to repay. The following will be on the liability side. Capital, because the business has to repay the owner. Drawings, this is the money that is withdrawn for personal use by the proprietor, therefore, it reduces the capital by 50,000. Therefore, it is now 9,50,000. Next is net profit of 1,50,000, which is added to the capital. This indicates that the net profit is reinvested into the business. Therefore, the net worth is 11 lakhs. Creditors are otherwise known as suppliers. These are other businesses which has given goods on credit, and we need to repay them. Bills payable and mortgage loan. Assets indicate what the business owns. The following will be on the assets side. Buildings, furniture, cash at bank, debtors, otherwise known as credit sales. When we collect money from debtors, it becomes cash, therefore, it is an asset. Now that we have transferred everything, let us add the liability and asset sides, both sum up to 17 lakhs. Always, the liability side and asset side should tally. This sums up the basic introduction to balance sheet.